Welcome to the Amell Financial Series. I have created a way to randomize personal budgets so that we can together do some demonstrations on how to create a personal budget, how to find out the monthly cash flow, look at expenses, to analyze the expenses, optimize finances, and then look into debt, servicing debt, and eliminating debt. So let's get into the financial scenario. So first we're going to pick the number of incomes that this household has. And they have 3 sources of income. So for this scenario, we're going to go with 2 working adults with a 3rd source of income. So we have $35,000 a year and $45,000 a year. Now for the 3rd income, I just have various amounts written down here that could be anywhere from $200 up to $2,000. And the places that this 3rd source of income could come from would be the Canada Child Benefit, disability payments, support payments. It could be investment income. It could be they have a business and that's what their business pays them every month. So there's various sources that multiple streams of income could come from. And so these guys are getting $400 extra as a 3rd source of income. Now the first thing we need to do is take their annual gross income. We need to take the taxes off of that, and we need to break it down into a 4-week monthly amount, because when we are budgeting, we want to use a 4-week monthly budget amount. So the purposes for that is because a lot of utility bills, cell phone bills, things like that come out on a 4-week basis, and typically people get paid every 2 weeks, and so it's just easier to just combine all of that within a calendar month, so to speak, but essentially using a 4-week cycle as a monthly budget and then just following the calendar months. Both of these incomes are less than $50,000 a year, and as we discussed in the budgeting post, for tax bracket purposes, less than $50,000 a year, we would estimate their taxes and deductions to be at 20%. And if they are between $50,000 and $100,000, it would be 25%. And if they're above $100,000, it would be 35%. But for these guys, we're going to calculate each of their taxes and deductions at 20%. Within the Essential Series, we do discuss how to specifically calculate your actual tax and deduction amount. That is optimal for if you get paid the same amount all the time, and if you're getting extra payments taken off for perhaps you buy into a stock program or a pension plan or something with your work, and your taxes and deductions are just different than typical taxes and deductions. It's nice to know exactly what your percentage is. And so we do discuss that in it's called budgeting, the various earning systems. However, if you are an hourly employee and your hours vary greatly, that might not be the best option for you, but you just have to do what's best for you. So for this, we're going to calculate the taxes and deductions 2 different ways. So for $35,000 a year, we're going to take the taxes and deductions off first and then calculate their 4-week monthly amount. So since everybody is different, everybody understands calculations differently, we are going to go over both of them. So the reason the first one, we are calculating 80%. So we're multiplying the annual gross amount by 80%, is because that's the amount that they're going to keep. So it's the fastest way to calculate exactly what their take-home yearly amount would be. And 80% in a decimal form is 0.8, and that would bring us with a take-home amount of $28,000. The other way to calculate taxes and deductions would be to find out exactly how much that the taxes and deductions are by calculating 20% of that. And 20% in decimal format is 0.2. So the tax amount and deduction amount is $7,000, and then you just have to do step 2, which is subtracting the amount of the taxes and deductions from their gross annual amount, which would give them their net annual amount or their take-home annual amount. So that's how much they take home in a year, but now we have to figure out a 4-week monthly amount, and there's 3 ways that you can do that. So you can divide their net annual income by 52, because there's 52 weeks in a year, and then you're going to multiply that number by 4 to get 4 weeks in a 4-week month. If you get paid every 2 weeks, that means you get paid bi-weekly, and that means you get paid 26 times a year. So you can also divide their net annual income. You can divide it by 26, and then to get a 4-week monthly amount, you need to multiply that by 2. If you want to go straight to the 4-week monthly amount, then you would just divide it by 13. All of these are going to come out to the same amount. You can definitely do the calculations on your own. But that amount is going to come out to $2,153.85. Now, when you are working with a budget, it is definitely beneficial to work with whole numbers. And in saying that, you want to round your incomes and your expenses. You want to round your income down, and you want to round expenses up. And that just creates a nice little buffer room when you're working with nice even numbers and you're not under budgeting for expenses, you're not over budgeting for income. So we're going to round that number down to $2,100, and that's actually going to give them already $53 in positive cash flow every month. So now we're going to do the same thing with the $45,000. However, we're just going to do it backwards. So what we're going to do is take the $45,000 a year, we're going to figure out the 4-week monthly amount, and then we're going to take the taxes and deductions off. So I am just going to go straight to the chase, and I'm going to divide it by 13. As I showed you earlier, you can divide it by 52 and then multiply it by 4. You can divide it by 26, multiply it by 2. I'm going straight to the source, and we're going to divide that guy by 13 to get a 4-week monthly amount, which is $3,461.54, and that is their gross 4-week monthly amount. So now we have to take taxes off. So we can times that by 80%, or you can do it the other way where you would multiply by 20% to get the amount of the taxes and then subtract the taxes from that total amount. But again, we're going straight to the chase. So now income number 2 brings home $2,769.23. As I said, we want to round that down to a whole number, and because it's an income, we're rounding down. So I'm just going to use $2,700. And between the two incomes, they're going to have a positive cash flow already of $100 before we even get into budgeting. So their income that they're bringing in every single month is $5,200. And now we are going to pick out an expense scenario. So this is their expense scenario, and we have written it down. Now, to make sure that we are on an even playing field here, we are going to take the insurance, which is actually a yearly amount, and we're going to break that down to a monthly amount, and dividing that by 12 to get a monthly amount, because there's 12 months in a year, it comes to 208.33. So for even sake, and because it's an expense, we want to round up. So we're going to say $210 a month. And now we have an even playing field. Those are all monthly expenses now. And what you might notice is that there's a miscellaneous fund down here that doesn't have a number. And that's because that you want to calculate 10% of the income that's coming into your household. So take 10% of that and put it as the miscellaneous fund. So for these guys, that would be $520 goes to the miscellaneous fund. We discussed the importance of a miscellaneous fund within the Essential Series, but I'll quickly go over the two main reasons that a miscellaneous fund should be a must within your monthly budget. When you're starting a budget, you might miss certain expenses. And one of the big ones would be like coffee and takeout expenses. Not a lot of people would actually budget for things like that. And in order to create a successful budget, you need to budget for everything that you are regularly spending on within a month. So this miscellaneous fund is going to give you a buffer. So that way, if you forget to allot for a certain expense, it can come out of the miscellaneous fund. So it's a good rule of thumb when you're learning to budget and you're starting out budgeting and you're figuring out your budget to give you a buffer. After you have successfully created your budget and for a few months you are living within your budget and you've had a positive cash flow, so you know that budget is working for you, then your miscellaneous fund is going to transform to an emergency fund essentially. And what that's going to do is it's going to allow you to come up with a certain dollar amount. That could be a couple $1,000s just to have as a buffer for all finances. It could also be you saving up 6 months worth of your expenses in case you get sick or something like that, that you're not able to work, you're not able to get funding like EI or something to help you out with your expenses. That's okay, because you have an emergency fund that is like 6 months worth of your expenses saved up so that you are okay and it's not a huge financial emergency at the moment. The other reason is unexpected finances, like unexpected expenses pop up. Emergency vet bills, cars breaking down, things like that. Things happen, you know what I mean? Life happens. So when unexpected expenses come up, it's nice to have not just a $520 buffer, but having multiple months of that saved up, set aside, all that stuff. And finally, once you have an emergency fund, once you've figured out your budget, it's working for you and all of that stuff, then your miscellaneous fund can actually go to funding savings and investments, and especially retirement investments, because you're the only person that is going to save for your retirement. And that really should be an essential concept, no matter how young you are or how old you are. It should be an essential concept and strategy to constantly be saving for your retirement. Because nowadays, unfortunately, CPP, old age pension, pensions in general might not cover the cost for you to live in retirement. So you want to make sure that you are able to have some sort of an amount that you are able to save up on a monthly basis over time that's going to compound in your favor. And that's what that miscellaneous fund can do. So we're going to calculate their expenses and we're going to figure out their monthly cash flow. So the good news is for this household that they actually end every month with a $1,600 positive cash flow. And that's really good news, especially if we haven't even gotten to this portion yet, but we are gonna find out if this household is in debt or not. And then if they are in debt, we're gonna be figuring out how in debt they are, what the percentage, the interest rates are on their debt products, etc. But by ending the month with a positive cash flow, they are living within their means. They have budgeted appropriately, and they actually have money that they can allot into other expenses if they find that the estimated expense amounts aren't high enough. Because especially when you are starting out with budgeting, these are all estimates. And until you sit down at the end of every month and you figure out what your actual expenses are and you're adjusting your budget amounts to make sure that you are staying within those estimated expense amounts, then all of this is just an estimate, and it's great to have a buffer to be able to increase certain expenses if need be. The one that stands out to me is $300 a month for groceries. That's probably not going to be enough, even for two people, to live off of $300 in groceries a month. So having that extra $1,600 in cash flow, when they sit down to analyze their budget at the end of the month and find that, oh, you know what, we might need to up that to $500, they have the room to do that. And that is one of the most vital concepts of budgeting. It's called the PDCA cycle, and we do talk about it in a post on setting goals and what SMART goals are. But the PDCA cycle is plan, do, check, and adjust. And so what you want to do is you want to plan for your budget, plan for your expenses, and you do that by budgeting. Then you do it. To go back to planning, you plan for your budget by writing out a budget, and you're going to estimate your expenses. You can go back and look at your bank statements, your credit card statements, to get rough estimates of what each of your expense categories should be and how much you should put in there. But especially the first time you create a budget, it's just going to be an estimate. Then you're going to run your budget throughout the month. You're going to follow the monthly amounts, and you're going to try really hard not to go over it. Stay within your budget in your expense amounts. Then at the end of every single month, you should be doing a check on your budgets. So take your debit card transactions, your credit card statement, however you're spending money. If you're using cash, keep those cash receipts and check what your actual spending is compared to what your estimates are, and then adjust expenses accordingly. So if you have underestimated an expense, definitely increase it. If you've spent less in an expense area, it still might be beneficial to keep the higher amount, but definitely adjust the amounts of your budget as time goes on and as you are seeing what you're actually spending. And that's what the A is adjust. So plan, do, check, adjust, and you should be doing that at the end of every single month, just to make sure that you are living within your means, your monthly cash flow is staying a positive number, and you are adjusting any expense amounts that you need to be able to stay within your budget. So this is all a positive. I'm going to figure out if these people are in debt before we analyze their budget and optimize their finances. Oh, I can see it. So yes, these people are in debt. And so what we're going to do is we're going to pick, there's numbers in here, and this is going to correspond with how many debt products these people have. That could be credit card debt, line of credit, car payments, like recreational vehicles, just debt in general. And they have 6 products of debt. And you might think that's high, but I at one time owned more than 6 products of credit. I didn't have balances on them, but just the fact that it was available to me and I could have put myself in a lot of debt is why I made sure that I did include high amounts of debt products, because that is a reality for some people. So 6 debt products. So this is just amounts written on a piece of paper. They can vary anywhere from $200 to $100,000. So I'm just gonna grab a handful and we'll start figuring out some debt amounts. Our first debt amount is $10,000. Then we have $5,000. And we have $20,000. $70,000. $8,000. And last is, just want to grab one, $800. So these people are in debt by $113,800 in various amounts. You might think that is unrealistic, but I have seen people in debt by that amount purely by consumer spending. So it is definitely a situation that somebody could be in, and that's why I've included it in this personal budgeting scenario demonstrations. So we now have to pick interest rates. So the first interest rate is 7%. Then we have 8%. 19%. 20, 20, and 20. So the first thing that I'm going to do, your 7 and 8% interest rates, that could be car loans, that could be lines of credit, home equity lines, things like that. Chances are they don't have a home equity line because they are renting. But point being, there are various credit products available at different interest rates. Your 19 and 20%, most likely credit cards. And that is a tough reality for a lot of people. Having high amounts of debt on products that have high interest rates, we're going to do the calculations, but that's really going to suck when it comes to having to service interest rate payments. Now, if you go to our post about, it's called Debt, Servicing and Eliminating It, we discuss exactly what servicing your debt is. Essentially, it's keeping your debt at the same amount because you're paying your monthly minimum amount plus the amount of interest that is added onto that credit product. So in order to keep your debt from constantly increasing every single month, you want to make sure you pay your interest rate and your minimum monthly payment. And so we're going to figure out purely how much it would be to service the interest on all of these. That does not include the minimum monthly amount. We are just purely going to figure out how to service the interest expenses associated with these debt products. Every credit product is completely different, so you are going to have to look into your terms and services on your credit products to find out how you can calculate your minimum monthly amount and then go from there. Best way to do it though is if you're going to start tackling your debt now, figure out what your interest rate is on your current balance and what your minimum monthly amount is, and then just round that up to the nearest $50 or $100 and keep that amount. And if you keep that as your servicing debt expense amount for that credit product, it should not increase because as you're paying the balance off, it's going to decrease. So to figure out purely how to service the interest expenses on these, you're going to multiply the balance by the interest rate. And so you want to convert all of your percentages into a decimal form. So 7% would be 0.07. And then you're going to divide that total by 12 to get a monthly amount. And then I am rounding up to the nearest $10. What we are going to discuss right now is the fact that just to service the interest rates on these debt amounts is $1,750, and their positive cash flow is only $1,600. So their positive cash flow amount alone is not going to be able to service that debt. So they automatically are going to have to start looking into their expenses to see where they can optimize their expenses, cut expenses, and figure out where they can start creating some money from within their budget to start to just service the interest rates on those. Now, before we even get into that, options available to people, you can go to your financial institution and talk to them about a consolidation loan. Chances are, if you have that much debt going on, you could be approved for a consolidation loan. That is nothing like a bankruptcy or a consumer proposal. A consolidation loan is a product offered by financial institutions that essentially allow you to group all of your debt together into one loan at a lower interest rate. And even if you weren't able to get the full amount of your debt available, essentially getting anything that you have high percentage rates on over to a lower percent like interest rate, that is going to help you in interest payments, because this right here, spending $1,170 on interest payments alone every single month, if they were just to move that one product down to a 10% interest rate and cut that in half, that's going to help them tremendously. So I just want to point that out, that there are options available that you can get loans to put everything into one place at a lower interest rate, and that's going to help free up some cash flow, and that freed up cash flow should actually be going to paying that debt off. But the point is that the majority of your monthly cash flow is not going to go to interest payments. It'll go to actually paying the balance of that loan or that product off. So let's get into analyzing their budget and optimizing their finances to figure out whether these people are going to now stay in a negative cash flow situation, or if we can free up some money and then kind of create a bit of a debt elimination plan. So if you are that much in debt, I am going to be tough about eliminating expenses. We at our household have been extremely tough, especially in the tough times, about eliminating certain expenses. And definitely go and check out wants versus needs. I believe we discuss it in the Analyzing Your Budget post, where we talk about what expenses that you can eliminate and understanding a want versus a need. And this, depending on what that subscription is at $40 every month, if it's a streaming subscription, or if it's a like FitFab box, or a box of like getting toys sent to your dog every month, that type of subscription, if that's what that is, I would eliminate that. However, if that is an antivirus subscription or a home alarm system or something like that, I would probably leave it alone. Internet's fine. Cell phone, you might be able to get cheaper, but not by much. Your sports, you might, unless that's your kids' sports, and for a few years, you might need to look at perhaps cutting that down in half and telling them that you're not going to do as many sports for the next couple of years, perhaps just doing like soccer in the summer and swimming in the winter or something like that, but something that is going to keep you within your sport expense. Our local sports only cost about $100 to $125, so 5 months worth of saving. They could go into summer soccer, and then another 5 months worth of savings, and they could go into some sort of a winter sport. But definitely in the tough times, we have personally cut down our kids' extracurriculars until we were able to better fund their extracurriculars. And in the tough times, you got to do what you got to do. So in this scenario, there really is not much that you can cut out. Their vehicles, I'm assuming, is how they get to work. Their gas, $300 a month doesn't seem like a lot for two or one person to get to work, so I'm not going to touch it. Rent, unless you can actually do some research and find a cheaper place to live, that would be your only option with looking at rent, or perhaps taking in a boarder. I know local hockey teams that are like the junior A's will look for people, like homes for their players to live in, and so that could be an option. Taking in like university and college students, things like that, like renting out a room might be an option to offset your rent costs. But just in this scenario, we have freed up an extra $350. Now don't forget, this miscellaneous fund is used for purposes like this, where if you find yourself in a lot of debt, that miscellaneous fund, as long as you have analyzed your budget, you've reworked your budgets work for you, you don't need to be putting money aside for an emergency fund as much. You can definitely take funds out of that. It doesn't have to be the full amount, but you can use that towards paying debt. So with 1,600, 350, and then if we take 300 from there, that gives us $2,250 to use towards paying that debt off. That would be a very slow debt payment process, which is why I had suggested talking to a financial institution about getting something, a product like a consolidation loan, or seeing if you have access to a line of credit where you can put some of your products that have high interest rates and a high balance onto a product that has a lower interest rate. And that way you can save some money on interest and really start banging money onto the balance of your debt. So having $2,250, that's only going to give them $500 a month to actually put onto the balance of their debts if they weren't able to consolidate or find lower interest rates. So what could you do? Essentially, the best way to tackle it, if you have no other options, would be to really look at your expenses and see if there's anywhere else that you can actually cut, and to get tough about it. You could look at, although these people are working full-time jobs, you can look at getting another part-time job for a short amount of time just to increase some more cash flow into the household in order to pay off that debt. But at $500 a month, that would be the first debt that I would tackle. As a rule of thumb, you want to look for the highest interest rates and then tackle the debt that has the highest interest rate but the lowest balance first, because that's going to free up cash flow in a quicker way. So I would tackle that debt first. Second, third, fourth, fifth, and sixth. That's essentially the way that I would pay that debt off. It would take a very long time if you are only getting $500 a month. Essentially, if that was your only option, your only payment plan, that would probably take about 20 years to pay all of that debt off. However, the good news is that as you pay the balances and you pay these off, you free up more cash flow. So within the first 2 months of having the $500 to pay onto their debt, they would actually eliminate this amount, and then the amount that they pay on interest goes to that amount. So it's now $520 they're able to pay onto the debts within 2 months. So that 20 years is not taking into account compounding and all of that stuff, because as your balance goes down, your interest amount goes down, and then you're able to put more cash flow onto the balance of the debt. Point is though, is that if this is their reality, then they are definitely going to have to tighten their financial belts, eliminate a lot of expenses, and start looking at ways that they can create more income coming into their home in order to eliminate that amount of debt. Definitely go and talk to their financial institution to see what credit products are available that they can consolidate the higher interest rates down to lower interest rates. And if they can do that, then they definitely have a really good plan for paying their debt off. The only thing, honestly, that is really hurting these people is these products right here at the 19 and 20%. And that's really why we want to make sure that people understand that credit cards, although a very useful tool to have, you need to make sure you are using them with diligence and discipline. Because if you are not paying off your balances on your credit cards and you're incurring interest, it can quite easily become a slippery slope like that. And that is a reality for a lot of people. So we just want to go over situations like this to show you, here's your options. I went over their options on paying off their debt. Go talk to their financial institution, see if there's a way to lower interest amounts, consolidation loan, things like that. And then aside from that, looking at, it might sound crazy, but looking at products that are going to earn them interest so that they can also earn more money is also an option for them. Might sound crazy, but I mean, if these people are willing to go out and get second jobs in order to bring more income into their household, then putting their money into a TFSA or an RRSP and investing that money so it earns them interest, same thing. So it would just be taking some of the funds that they have and buying investment products that are going to make them money instead of going out and working for that money. So that's definitely an option, but always sit down with a financial expert, a tax consultant, a banker, somebody like that you can discuss all these options, because your personal financial situation is going to be different than this one or other people's. So it's nice to just sit down with somebody and discuss what your options are, especially when you've learned of new options you hadn't thought of before. Take that to the bank and talk to them about it and see what your options are. I hope that this demonstration and scenario helps you understand how to create a budget, how to figure out what your monthly cash flow is, and then if you are in debt, essentially making sure, one of the things I didn't mention is this amount, the $1,750, should now actually become an expense in their budget. We discuss it on the website within the Essential Series, that when you are in debt, servicing your debt now has to become an expense within your budget. So that $1,750 should actually be included in their expense list, and that is now an expense they have to budget for. And that's why they only had $500 available to pay onto their debt. So, but anyways, I hope that this demonstration helps you understand finances, how to analyze a budget, optimize finances, and see what potential options are available to you if you're in a situation that's similar to this. So I hope you enjoyed and have a good day.